Welcome, America, to Max Drew, CPA and financial coach coming out of Sacramento, California. I'm a licensed financial advisor, CPA, and insurance provider in the state of California. And depending on licensure requirements, may be able to meet licensure requirements in other states as needed if you want to hire me for personal financial coaching or investment or tax advice. Feel free to reach out to me, specializing in investments for small businesses, individuals with high net worth. Now, today, just remember that this video is not intended as specific financial advice, but just a way for you to get to know a little bit about me, a little bit about my style, and how I talk to my clients. The name of this initial podcast, which I intend to be a weekly podcast, is called Searching for 8%. Now, the reason why I call this Searching for 8% is because I've interviewed hundreds, thousands of people, and I ask my clients, I like to start out by getting to know my clients. I've asked my clients how much do they expect the stock market in general can give them. And the most common answer seems to be 80, 90% of the time, perhaps even more, is 8%. When I review my clients' portfolio, since I am a CPA, I get to see what their advisors are doing. And a lot of times their advisors are doing somewhere between 4% and 12% in their portfolios. Now, I have a special method that I like to use to advise clients, and it involves education. So I'm going to show you that today. We're going to take a look a little bit about stock market education, learning about the indexes. We're going to also talk a little bit about some companies I like in a special segment called Under the Hood. And I'll explain that to you, a certain sector of stocks that I think are very interesting right now to look at. Remember, I'm not going to suggest that you choose these for your investment portfolio, but for some people, they could be suitable based on their own decision and working with their financial advisor, whether that's me or someone else. Finally, we're going to look a little bit at stock market history, and we're going to end up looking at stock market recent events or something to do with the economic recent events. So you'll see more about that later on in the video. Okay, and the first thing we're going to look at is my YouTube channel, just so you can recognize it. If you go to YouTube, you type in @MaxDrew, you should be able to find the channel Max Drew CPA and Financial Coach. Remember, this channel does not offer specific financial advice to the public. Rather, this is just information for you to consider for entertainment purposes. If you do want specific advice, feel free to contact me directly. I do offer financial advice through my company, Financial Client LLC. I offer tax advice through my firm, Magnum CPA. I also help people nationwide depending on licensing and registration requirements. Feel free to contact me if you want to learn more about that. Today, I'm going to start out by looking at what I call the grandfather of the indexes. And we're going to be looking at the Dow Jones. And usually when I meet with clients, every time we go over a brief history, the Dow Jones is called the grandfather of the indexes. Now, this is my own terminology. And you might say, what does the grandfather indexes mean? Well, this tends to be the oldest by age of the indexes that we tend to look at. Now, this is made up of 30 different constituents, which means actually 30 different stocks. And of course, this makes up about $19.5 trillion in our economy. If we want to learn more about it, we can go to Wikipedia, of course, the source of all modern knowledge, I say with a little bit of joking involved. But we can see that this index is about 140 years old. Now, this is comes around what I call the start of what we call America 2.0. That's America after the Civil War. Of course, we might want to remember that our country was divided into two countries, torn asunder by the South and the North, and then later we came back together during Reconstruction. And that's about when the Dow Jones came into play. So today we're searching for 8%, and we want to see if we can find 8% performance in the Dow. Let's take a look at the year to date in the Dow Jones. Year to date, it's down 0.69%, almost flat, but let's take a look at the 1 year, see what the 1 year is doing here. Over 1 year, we're actually doing about 10%. Well, for those people who are looking for 8%, it looks like the Dow Jones this year has done close to about 10%. So not too bad. Let's go ahead and take a look at another index, the S&P 500, and see what that's been doing. Now, the S&P 500, as you might want to remember, is the largest 500 stocks in the United States. And when I say largest, that's according to how much money it would take to buy one of these companies. The biggest 500 companies are in the S&P 500. This one is worth about 50 trillion, so roughly 2.5 times the size of the Dow Jones. Hint, hint, just to remember, the Dow Jones companies tend to be large, so actually they're large enough to be in the S&P 500. So 30 of these 500 companies are actually Dow Jones companies. They're publicly traded in the United States. And I believe this makes up about 70% of the equities in the United States. So if we want to know how the American stock market is doing, on average, we can take a look at this index. And the year to date shows us about 0.34%, a little bit less than 0.5%, at 12%, 11.8% to be exact. And then we're going to take a look at the next one. The next one is, now remember, this one started in 1957. It's about half the age of the Dow Jones. The Dow Jones is 140 years old. This one coming in at just 68 years old. Now the next index came in. This is my little memory trick for the NASDAQ. The NASDAQ came in shortly after the moon landing. So we're going to take a look at that. So if you want to remember what this one's about, you can remember that in 1969 we made it to the moon, and in 1971 start of the NASDAQ. Now the NASDAQ kind of reminds me of that agency that got us to the moon, and of course that agency was NASA. And remember, the astronauts can only eat soft serve ice cream, so that's where the DQ comes in here. That's just a joke, but it's also a little memory trick that I use to remember things. Let's take a look at how this is going. This is a little bit more tech oriented. So we'll take a look at this. For the year to date, it's been down about 1%. For the 1 year, it's doing about 13% positive. Not bad for what's supposed to be a terrible year. But we're going to take a look at the year to date, how that's been performing. NASDAQ 100, of course, this is the top 100 companies in the NASDAQ that are non-financial companies. So you get to take out the JP Morgans, the Chase, Visa, MasterCard, Fannie, Freddie Mac, all those kind of types of stuff. This represents about $25 trillion right now. And we can see the year to date, it's actually at a positive almost 2%. So the NASDAQ 100 has been doing really well relative to other indexes. For the 1 year, we're coming in at almost 14%. And I like to look at them in order of when these indexes were created. I start out with the Dow Jones. Dow Jones over last year did 9.5%. Over the 5 years, it did 65%. So on average, we could say about 13%. Over the last 5 years, it's been doing close to 19%. 19 times 5 would be 95. So if we were rounding up, we could say it's been doing about 19% a year. So pretty good. We can see that the indexes and their 5-year averages are averaging higher than the past year by a considerable amount. Now the NASDAQ, over the last year, it's been doing about 13%. Over the last 5 years, it's done 101%. So on average, this index has returned about 20%, a little bit more than 20%. Let's take a look at the NASDAQ 100. NASDAQ 100 has been coming in at 13.78% this past year. Over the last 5 years, it's coming in at almost 25% a year. Pretty good way to make money. In just a minute, we're going to take a look at what these all have in common. Perhaps the more conservative of the indexes, if you want to think about that. We're going to look at the S&P 500. Like I said, somewhat related to the Dow Jones because they do share 30 of the same companies, and about 40% of the equity of the S&P 500 is made up by the Dow. And we also see some ups and downs. We see this up around 2022, ended up taking a significant dip that year, and then comes back up. And then around the time of these terrible tariffs, everything went back down. And now it seems like things are starting to come back up. But we'll see how things go. The next index, to see if we see the same type of a line, is going to be the NASDAQ. And the NASDAQ, we also see kind of a similar line going up and down. Let me see if I can bring up the bottom here a little bit so we can take a look at those years. Okay, there we go. You see it, 22 had kind of that peak, and then it kind of went down towards the end of 22, 23. Since 23, it's kind of been all the way up until we reached those terrible tariffs again. It came down, and now it seems to be coming back up. So the good news is the indexes on average over the 5 years are trending upwards, and we are going through some up and down. But of course, people say if you want to get good returns, you have to be willing to experience some market volatility. And we'll talk more about that here in a minute. Now, the next thing I'm going to look at is the NASDAQ. Kind of reminds me a little bit of a roller coaster ride. But if we're in the stock market, if we're investing, and if we stayed invested, we'd be happy that overall, during the past 5 years, it's been trending upwards. So the thing that I wanted to point out is all of these indexes, though one has a more robust return than the other, they're all basically following almost the same line pattern. And that line pattern, for the most part, is a line pattern reflecting one of the risks or one of the things that changed the market, which is market sentiment. All right. Now, today I want to talk a little bit about an important person in the stock market many of us have heard about, called Warren Buffett. One of his nicknames is the Oracle of Omaha. Seems to be a pretty kindly looking person. I don't know a whole lot about him personally, but I do know a lot of people admire his picking techniques. And I'm going to talk a little bit about what I believe is some stocks I picked kind of using his techniques. And we're going to take a look at what those techniques are. So Warren Buffett, according to the AI overview, now I know this tends to be about 80% right. So if something's off, blame AI. And I'm giving you the double check all these facts for yourself. This is for entertainment purposes. But Warren Buffett says, invest within your circle of confidence. Focus on businesses that you understand. Look for strong, consistent earnings and growth. Now, for me, that usually means looking for a 5-year trend to see if the stock's growing upwards, but he's talking a little bit more about company profits, things like that. Seek a high return on equity. Okay, we want our equity to be a high return. Prefer companies with strong competitive advantages. And then, of course, understanding financials, etc., etc. And he goes a little bit more onto that. You might want to go ahead and take a look. Of course, hold for the long term. Warren Buffett's not into day trading. And of course, if you've ever looked at day trading, I think about 90% of the people end up losing money in day trading over the long term. So thanks for bearing with me while we had a brief review of the indexes, and we learned a little bit about Warren Buffett and his method of stock picking. Now, today I'm going to examine some stocks that I've been holding in my own portfolio that have done quite well over the long term. I kind of chose them somewhat based on the Warren Buffett method because I inherited a while back when my father passed away. I inherited a 2003 Honda Accord. and it needed work. And in fact, I've always kind of been a fan of having used cars. Recently, I did buy a Tesla, and I love good cars that last indefinitely. I'm talking about things that get 400,000 miles or whatnot. Now, of course, during the pandemic, the last 5 years, we were seeing all kinds of different things happen to the economy. Tax changes, stimulus changes, all kinds of different things. People staying at home, people buying bigger houses, people moving to the country, all kinds of things happen with our economy. Well, one of the biggest things people did during the economy is they went out and made a major purchase. And besides buying a home, what was the next major purchase that people were making during the pandemic? Do you remember? Well, it has to do with some of the things. Remember, one of the things that was happening, everybody was getting their catalytic converter stolen. And then later, people were having to replace their catalytic converter. But also, a lot of people were buying new cars during the pandemic. The car sales went up, and the used car prices went up too because of demand for auto parts, or demand for new cars, or demand for cars overall. And there just weren't enough to satisfy the appetite Americans had for buying new cars. I decided to invest in some of our places where you go to get your car repaired for the do-it-yourselfer people. You might know which places I'm talking about. There's two local shops that many of us go to buy parts for our car. And what I'm thinking is, when you buy a new car, one of the first things you go out to is you buy new mats, you buy air fresheners, you buy a little suction. And when you don't have money, a lot of times you're taking that old car and you're trying to fix it up and make sure that it can keep running, because you can't afford to buy a new one. You need to keep it going. So the reason why I chose these stocks, these ones I call the under the hood selections. And we're going to take a look at several stocks that I think aren't necessarily the sexiest stocks out there. And I don't really think a lot of people are talking about these stocks. You, as somebody who's interested in investment and learning about the stock market, you may want to take a look at these stocks. And what we want to look at is, I've been looking for stocks that I hold in my own portfolio that actually have returned better than the market average and also don't have the same downside volatility. But what if we could find an investment stock that when the market was up, it had good upside potential, and when the markets were down, it didn't seem to be going down? Well, I'm going to be talking about those places where we bring our car to get repaired when the market's good, and when the market's even better, we'll go to get upgrades for our car. Let's take a look here. It's up 1.32% today. Everybody go out and buy, right? Are we supposed to buy high and sell low? Or maybe it's the opposite way, just a joke there. But tends to be that's what people like to do. They like to buy a stock when it's going up. Let's look at how this is done over the last 1 year. Over the last 1 year, this stock has done quite well. It's done 36%, outpacing the indexes by 2 to 3 times in general. This year, it's probably been doing close to 2.5, 3 times the indexes, depending on which one you're looking at. So this is AutoZone. Now, another place you might be bringing your car to, you remember this section is called Under the Hood, is their big competitor, which I like to think of is O'Reilly's. And remember, when one stock's going up, the other stock is probably going to be suffering from the competition. O'Reilly stock is down today, but over the last 1 year, it's actually up about 41%. Once again, beating the indexes quite a bit. All right, now the last one I'm going to call my Under the Hood series is the place where you're generally going to buy car insurance. You remember that lady who's got the blue headband who's always trying to sell us car insurance? Flow. And let's see how Progressive stock has been doing over the last year. It's also coming in at about 36%. So these stocks are all doing pretty well, and it's what I call the under the hood stocks. So remember, when we're looking at stocks, you may want to look at the year-to-date the 1 year and the 5 years. I always like to look at the 5 year perspective on these stocks to see how they're doing. So let's take a look at AutoZone. What did it do over the last 5 years? AutoZone did 226%, almost 45% a year. Now, one thing you might like about this line too, when we look at it, the line has a lot less downside volatility than the other lines, according to the Dow Jones, the S&P 500, and of course the NASDAQ and NASDAQ 100. So it's got higher than upside participation, and we're not participating in the normal volatility of the market sentiment when it goes down. And like I said, according to my theory, it is because when the market's up, we're trying to upgrade and enhance our cars. And when the market's down, we're also trying to repair our cars. So that's Max's theory. Let's look at the O'Reilly stock, see how it's done over the past 5 years, where it went down quite a bit here, but then generally came back up. And overall, it's performed at about 45%, very similar to AutoZone stock. So take that for what you will. I think that's pretty good. Now, of course, when we get pulled over by the police, the police, they're going to be asking us for license, registration, and insurance. So let's take a look at how our insurance lady Flo, how her stock's been doing. For all the people that have Progressive, you might want to take a look to see how profit they've been making off of your policy for the shareholders. So over the last 5 years, Progressive has actually made a 256% increase. And what we like about this line as the people who might be holding the stock is it's mostly all upwards. And now, of course, there were some times during market adjustments, even in 2022, there was a little adjustment here in 2023. But overall, it's been trending upwards at a rate of about 51% a year. So, and we're going to be taking a look at a stock that fits into the auto parts repair category. This one's called Napa Auto Parts. Of course, I used to live nearby Napa in Sonoma County, but Napa used to be wine country. But they call this Napa Auto Parts. I think it's something like National Auto Parts Association or something like that. Let's take a look at what's happened with Napa here recently, because we kind of an interesting story. It's performed a little bit different than AutoZone and a little bit different than O'Reilly. So let's take a look at that, see what's happened here. When we take a look at them, they go by the ticker symbol at GPC, Genuine Parts Company, by the way. And last day or so, they were down 1%. We look at the last 1 year, they've been down 10%. Oh my gosh, how could this happen when everything else is going up so much? Well, maybe we'll learn a little bit more about that here in just a minute. Let's take a look at the last 5 years, though. The last 5 years, they've actually been doing about 10% a year. I remember when our financial advisor was telling us that we should be doing 8% a year, you might think, oh my gosh, this one did 10% a year. Thanks for picking up the stock. You must be a genius. Of course, when we compare to some of the other stocks in the auto parts place, the other ones did well. But what happened here? Well, there's a little bit of a backstory. They had a little problem with their pension fund. And I believe the adjustments to the pension fund and health of the company and the health of the stock took a hit due to that adjustment that I believe they were underfunding their pension. I don't know all the exact details. So if it's a little bit different, don't hold me to the exact story, but I understand from the brief amount of research that I did, that may have been what has contributed greatly to their downward. Definitely, out of all the different auto parts stories, this one doesn't follow that robust participation upside curve. However, they might have had a special event with their pension fund being underfunded and discovering that in 2023. Probably if it wasn't for that, they probably would have kept trending upwards along with the other companies. All right, now I'm going to take a look at another company That's another insurance company, an auto insurance company, one that we often think of. It's got that lizard or that gecko or whatever it is. Of course, the name of that company is Geico. All right, let's take a look at Geico. We're going to jump ahead here. Now, Geico is actually owned by Berkshire Hathaway. Let's take a look at how Berkshire Hathaway's done over the last 1 year. Over the last 1 year, it's done 24.5%. Okay, almost double what some of the indexes have done over the last year. Let's go ahead and take a look at the 5-year. See what we're doing in the 5-year. Now look at this. Now, one thing that you might find interesting is even though Warren Buffett's probably a lot more diversified, you see how he's following that line where his line's almost all upside. Now, it does look like things went down a little bit kind of in 2022, but it did recover a lot better than most of the other stock market indexes and lines that we're looking at. So see, Warren Buffett, like me, he likes to see the steady line upwards that's outperforming the general market when possible. And when we have downside volatility, it's performing less than the downside of the market in general. I can't necessarily speak for Warren Buffett, but if I were to guess, I think he would find today's episode of Searching for 8% somewhat interesting. I think he would like these stocks that we're looking at. Of course, that's just my own speculation. So far, we looked at Progressive, we looked at Geico. Next one we're going to look at is Allstate. Looking for a normal Allstate chart, and for some reason, I was having trouble finding a good chart on Google or Yahoo. But let's take a look at what I was able to find. And of course, I'm relying on these sites for accuracy. You feel free to double check these on your own, but I think they're probably pretty accurate. So for Progressive, for the 5-year trend, it looks like, according to this, we're seeing that it has performed at about 140%. So relatively good returns for Allstate. Okay, you remember the spokesperson for Allstate? I think he had a pretty deep voice. All right, for the next section, we're going to go back in stock market history, and I want to briefly look at something that affected the stock market greatly years ago, and we're just going to touch on an old person who I believe he was high up in the SEC, a big investor who did some embezzling. I've heard it called the biggest Ponzi scheme in American history, named Bernie Madoff. And I just want to briefly take a look at Bernie Madoff. Now, Bernie Madoff in 2008, he was convicted of a massive Ponzi scheme, which defrauded thousands of investors and amounted to $65 billion. Now, this significantly affected the stock market at that time. And if you want to learn more about it, you might look at that. But $65 billion, that is a lot of money. Today, we're going to look at something that is a scandal, I believe, in the brewing. You can decide for yourself. But recently, one of our senators, John Kennedy, he was trying to be a watchdog for our taxpayer dollars. Now, remember when the Madoff thing, that was a huge scandal. Kennedy was asking about $93 billion in loans that got issued from the Department of Energy. And it was issued to people within a 76-day period. Often the organizations looked like they were just created out of almost thin air, and organizations that didn't have any business plans. And there are organizations with very little accountability, unsecured loans, $93 billion of U.S. hard-earned taxpayer money, and apparently with no business plan, no history of the business for most of them, no accountability. And I think this might be money that we probably won't see any results from and probably never get paid back. How does this stuff happen in the American economy? I wonder, but it seems like there might be concentrated efforts by groups of people to take advantage against the American people and the American taxpayer. So whether we'll ever see this money again or see any results is yet to be seen. But tell you the truth, I'm not very optimistic that we'll see much about it. And I wonder how this actually goes through. But we'll see here. We're just spectators on the sidelines. But I wanted to talk to you about this, and I wanted to wonder, do you think this is going to affect the American stock market? Will this type of thing affect the American economy? Will it rock us like the Madoff thing? So far, I don't know if I've seen much or heard much about it. I don't know if I know enough about it. So if you want to add a comment or tell us what you think about that particular story, feel free to let us know. I hope you've enjoyed this episode, the very first ever episode. Hopefully it's going to be a weekly episode, talking a little bit about some interesting stocks, talking about the index, a little bit about history and a current event each week, coming to you from me, Max Drew, CPA, your friend in the finance business. All right. Hope you're having a good one. Take care. Love you all. Have a wonderful rest of your week. Thanks so much for joining me on this first ever episode of Searching for 8%. Take care. Bye-bye.